another panel coming up here at 3 o'clock. I want to thank all of our members, especially our sponsors for this event nationwide: Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Entrust Global, Off the Chain Capital, and Clarion Asset Management. We have a great group of general partners that are part of our organization, and I want to thank each of them for helping to make this event possible. Without your support and your guidance, we would not have been able to produce this or the last 3 events at such a high quality. We have a lot of good stuff that we're building out for you to, increase the user experience. Thank you to, again, all of our members. Tomorrow we'll be doing a presentation at 1:30 on some of these improvements and talking a little bit about our special situations marketplace. So if you're a buyer or a seller of assets and you want to learn more about our marketplace, please show up for the presentation tomorrow at 1:30. Part 5, if you're not registered for it, register. We are making it a 2-day event. It's going to be July 15th and 16th. It is not going to be live from New York City like we had hoped due to travel restrictions. So, we hope to be back in the flesh in October of this year. I would have never have believed this thing would have carried on for so long, but it did. And for people living in Florida, there's going to be a quarantine for 14 days traveling to the tri-state area, possibly. So that was ultimately our decision to cancel the live broadcast. Here's a list of upcoming educational webcasts on a wide variety of topics, like experts in various fields. We encourage you to register through our website for any of the upcoming webcasts. Our marketplace, if you haven't joined, please join. And with that, we are at real estate development, land acquisition. Liz Ferber, are you on?
I am. Can you hear me, Michael?
I can. It's great. It's great hearing from you again. Thank you for moderating this panel today. I'm going to turn it over to you.
Thank you. Thanks for inviting me.
And also, Liz, yeah, if you don't mind taking a little extra time because I ran over, so just build that into your schedule.
Okay, great.
All right. Thank you.
Thanks, Michael. It's great to be back here with Flya. Good afternoon, everyone. This is Liz Ferber from High Street Advisors, and I'd like to welcome you all to the Real Estate Development and Land Acquisition Panel. We hope this will be an interactive discussion with audience participation, and we welcome your questions as we go along. And before we get started, I'd just like to thank you again, Michael, and the Flya team and all the sponsors for hosting this timely event. So this expert panel will explore how they are currently reacting to the crisis and what their plans are moving forward. We'll have a candid discussion on location and the best types of real estate opportunities to develop today, including where the equity is coming from and what the projected IRRs for these upcoming projects. We'll start with a short introduction of our panelists. So as I mentioned, I'm Liz Ferber, moderator of today's panel. I founded High Street Advisors in 2012, and we are a marketing and consulting firm for alternative investments, including real estate, private equity, private debt, and hedge funds. We work with family offices, high net worth investors, RIAs, endowments and foundations, pensions, and sovereign wealth funds in helping to identify opportunities in these areas. I've been in the investment business for over 30 years, originally in New York City, and I'm currently based just outside Boston. And now I'd like to ask our panelists to introduce themselves, starting with Eric Berman, Chief Investment Officer of Life of R. Eric?
Thanks, Liz. Hi, everyone. Good afternoon. Eric Berman, CIO of Life of R Investments. We're a boutique real estate investment development firm, also hospitality operations. We're focused primarily in Latin America and the Caribbean. Right now, we have current projects under construction in Puerto Rico and in Colombia. We also do have a small hotel and acquisition in Porto, Portugal. We'll invest in hospitality, mixed use, and multifamily, anywhere from boutique hotels to luxury residential condominiums that are typically optimized for short-term rentals. So we'll call them a turnkey investment product for investors who like to own second homes in other destinations. Our investment strategy is typically value add and opportunistic, and we'll also look at distressed asset deals. In Puerto Rico, we run 2 qualified opportunity funds. So I think we'll talk a little bit about opportunity zone investing, and looking forward to the conversation today. Thanks for having me.
Great. Artem?
All right. Hi, my name is Artem Milinchuk. I am the founder and CEO of Farm Together. Farm Together is a farmland investment platform with a variety of investment products built around US farmland for accredited investors. So right now we have individual deals available. We also have separately managed accounts for people looking to invest a little bit more kind of than your average, 50, 100K check. And we focus mostly on US farmland with target returns between 7 and 12% in net IRRs. We'll talk a bit more about farmland, but it's the oldest asset class. It's really uncorrelated to most other asset classes, has good protection in times of inflation and recession, which is what we're going through right now. And overall, despite being a $2.5 trillion market in US alone, it's still virtually untapped by kind of formalized investors. Less than 2% is owned by a sort of investor. That is changing rapidly with a lot of institutions, endowments, foundations, as well as high net worth individuals, family offices, and RIAs moving into the space. It's definitely part of real estate, and our view is that everyone can benefit from having a few percentage points of their portfolio allocated to farmland. So look forward to this panel.
Thank you, Artem. Federico?
Yeah, hello, Elizabeth, and hello, everyone there. So my name is Federico Cerdas. I am the co-founder of Cobra. That's a real estate development company investing in residential for sale, multifamily, and mixed-use real estate projects for throughout Mexico, with an attractive adjusted risk return, for our investors. We're used to work with institutional investors, basically from America and Canada, but we're also used to work with high net worth individuals or different type of angel investors that want to expand their properties here in Mexico City. We are a vertical integrated company that allow us to optimize our operational processes and thus shortening our pre-development, construction, and commercialization times. Our residential strategy is focused on the development of small to medium-sized projects in Mexico City and its metropolitan area, catering to its growing middle-class sector. We have completed more than 100 projects throughout our 18 years of experience, and we have delivered results for our investors year after year. That's Cobra, and thank you for having us here.
Thank you, Federico. Dr. Sangani?
Hi there. Good afternoon, everybody. Anchor Enterprise is a diversified real estate investment company, and we invest as a co-GP in different real estate vehicles, and also we own and operate upwards of $1 billion, $2 billion of real estate in our company. We also syndicate and take investors in those syndicated deals. We also have a public vehicle in Israel where we floated $175 million worth of bonds based on real estate investments in the United States. Our elevator pitch is that no investor has ever lost money with us. In fact, I do not recall any deal that we have done, the investors have not received a double-digit return. So we are very, I should say, I want to be lucky than smart any given day, right? And that probably has worked out well in our favor, and looking for this particular turn of events to capitalize on it and help other investors as well as ourselves to find good investments.
Great, thank you, Dr. Sangani, and thank you all for those introductions. I'd like to get started by asking the panelists what their personal outlook is on how COVID-19 will ultimately affect the various real estate verticals that you're all in with respect to projects currently under construction, as well as new development opportunities. And maybe we can start with you, Eric.
Sure. So we as I said, we primarily invest in the hospitality space, and that's obviously an industry that's taken a big hit throughout the coronavirus crisis. I can tell you from experience that our project here in Old San Juan, we were under construction and the island underwent a full shutdown on March 15th. So we closed down and then we reopened about 2 months later with about half of the construction crew back in there. Fortunately for us, we weren't operational. So there are many hotels that had to, as everyone knows, had to furlough employees and use up cash reserves. And so really the extent of the impact was a delay in construction and we'll push back the opening date. There's, of course, a silver lining in that tourism, I think, will take a bit to recover. I am confident, bullish on it recovering, but it will take time. So in construction, I think many people, we haven't drawn loan funds yet, so we're not incurring interest expenses, which I imagine many development projects are. So that would be an issue that many people are probably confronted with. As far as my outlook on the development horizon and deals that may come into the pipeline in the future, I think we're going to see in anywhere from 6 to 12 months, depending where you are in geographic location, there are going to be deals out there. No doubt there will be distressed asset deals. There will be hospitality operators who can't survive or who are looking for liquidity events, need to move some capital around. And, real estate and hotel real estate is notoriously not such a highly liquid asset class. It takes a bit of time to realize these types of transactions. So for those who are in a position to be in acquisition mode and looking for good deals, I think there will be some out there.
Thank you. And while we're on the hospitality topic, maybe Dr. Sangani, you can weigh in on that question.
Sure. The hospitality sector is probably one of the worst hurt sector through this COVID situation. And my answer will be formed as we stand today and what I think is going to happen about 90 days or 180 days from now. So as of today, there is no lender out in the market. And when I'm just generalizing, there's always special circumstances and situations there. So even if you wanted to do a hospitality deal, the lenders are all gone. And then so there's no way to consummate a deal unless you're going to do all equity. And there's not enough blood in the street that it's worthwhile doing it today. So hospitality sector has come to a full stop as we speak today. Forget development, forget acquisition, everything is at full stop. And just like Eric was explaining, the operating companies are in dire trouble. Now PPP has saved the day for a short while, but in my estimation, till the airplane travel is fully established, this is going to be a very difficult situation for everybody to come back and have the same situation like what we had before. As far as 90 to 180 days from now, once the establishment of air travel, which could be as soon as the vaccine is available, which should be able to pretty much count on it. And once we know that the recovery is V-shaped, which everybody is now saying it is going to look like, not a U-shaped or a W-shaped, then the confidence will come back, the lenders will come back. And the Congress is also looking at a particular act that will mark to market and CMBS debt relief, and all those things happen, then I think everything will go status quo over the next, just like Eric was saying, over the next 12 to 18 months, I think we have enough things to celebrate.
Thank you, Dr. Kasangani. Changing real estate verticals a bit. Federico, do you want to give your thoughts on how your space is being affected and where you see development opportunities and challenges today?
Of course, Elizabeth. In Mexico, as many other parts of the world, industrial and residential assets, have been the most resilient. Offices, retail stores, and hotels, have been the most affected ones. In the first two assets, a growing opportunity is present in our country. This is because, the USMCA treaty that will start on July 1st, will trigger our integration as a region and help Canada, US, and Mexico to become the most dynamic economical region in the world. This will detonate in our country the need for more industrial hubs, which in turn, will be requiring roads, railroads, ports, airports, and residential areas to support those business activities. There will be a greater demand for the real estate sector, that will need to develop all those industrial parks, residential areas, offices, and commercial establishments, And we are, thinking that there will be an economic inflow, in the next 5 years like we have never seen before. Additionally to this, the USMCA, a demographic bonus that our country has, is second to none. And a growing middle class in new urban areas is looking for better homes to live in, and this is pushing the demand of residential developments forward. Additionally, a yet unexplored multifamily business, can also be the answer to these young Mexicans that are looking to live near where their work is, And just in Mexico City, just for you guys to know, there's a 60,000 unit deficit that year after year is not covered by the developers here. With these two things, in mind, we expect that the next 12 months will generate interesting business opportunities that will start with this new business cycle. This is the way we see it, and thus, our strategy is aligned, with this vision. This is the way we're just looking at it, Elizabeth.
Thank you, Federico. Moving over to farmland, Artem, maybe you could tell us a little about farmland investing and how does Farm Together work and your specific challenges given the crisis and where you're seeing development opportunities going forward.
Yeah, absolutely. So, farmland, the way it works is really, it's a type of a real estate investment. Typically, you have two sources of income. One is leasing out the land to the farmer and collecting a rent check. And it's a very common practice, actually. More than 40% of farmland today is rented. The reason that landowners like is obvious. You get to collect a stable paycheck plus revenue share or profit share, depending on how much up the risk curve you want to go, how much exposure you want to have to harvest. What I think most people don't understand, for them, renting land allows them to spread the fixed asset base, the equipment, the knowledge, the workers over a larger acreage, and capture a lot of the economics from that, while not tying up the capital in what is more of a stable, long-term kind of investment. So it's very similar to real estate, where most whether it's office space, whether it's retail space, H&M, Nordstrom don't typically own these stores, they will rent them. It's very we typically purchase the time for sale because of the generational shift happening right now, farmland ownership, where about 70% of farmland is expected to change hands in the next 20 years due to the aging of the farmer and kids don't wanting to farm, to buy the land. We find a great farmer typically in the area that is vibrant and kind of big. Just a little bit about the data points here before I jump into the answers to your questions, Elizabeth. The farmland historically from 1970 to 2015, actually 2020 now, has delivered about 10% annual returns, composed roughly half of price appreciation and half its cash yield. In the last 20, definitely very resilient and stable. It's first time quarter since the establishment of the NCRE Farmland Index, kind of the the Nasdaq, the New York, the S&P for farmland. But when we say negative, I think it's going to be something like a was minus 0.5%. So very stable investment, likely to recover quickly. In terms of the developments that are happening, definitely there have been some short-term constraints, some short-term issues due to COVID. Mostly it's been around transporting, getting the the food, the produce out of the country, partially due to just a shutdown in travel and in shipping as well, partially due to some short-term strains on the infrastructure. But overall, we expect that to recover as we kind of go through the motions. Already we're seeing signs of that recovery. What's good and what I like about kind of farmland investing right now is that we have quite a few sort of downside cases have realized in the last couple of years, where trade war with China, lower commodity prices versus what we had before. So in my view, we're kind of definitely not at the top of the cycle, maybe in the bottom, approaching bottom. So overall, I would say that our view on farmland remains very strong. It's structurally driven by growing population, improving diets, and decreasing supply of farmland. And then within the sectors we play in, this also value-added sectors such as tree nuts, almonds, citruses, apples. We're looking at also additional value adds such as organic or what's called regenerative sustainable agriculture that helps us capture carbon back in the soil, and there's a lot of demand for that as well. So that US is a global powerhouse in agriculture. People have to eat and have eaten for thousands of years. We'll continue to do so until maybe we become AI or whatever the Elon Musk and other tech whizzes are dreaming up. That there's some impact from the cycle, but for us personally, it's been a huge inflow in demand over the last since basically COVID hit. I think it's because people are waking up and woke up to the fact that they want to build resilient portfolios that are not as exposed to this volatility, and that stocks don't always go up as they have in the last 10 years. So we're kind of waking up a little bit to the realities of longer term investing.
Great, thank you, Artem. Next question I have is kind of three-pronged, and that would be, what lessons have you all learned from past recessions, and how did they shape how you're handling today's crisis? Have you learned any new lessons from going through this crisis thus far? And what steps have you taken, or will you be taking, to position yourselves and your companies to emerge from the crisis when we can get back to work? Eric, do you want to get started?
Sure. So I'll take it in the order of questions as you pose. You might have to remind me as we go. But from the hotel industry, I'll speak to that. Traditionally has always gone through cycles. And so, people say that it's a 7-year cycle for going through the peak to the trough. Recently, though, we've gone through 10 years without a cycle turn. And so the industry was kind of due for it. And every segment of real estate will go through cycles. I think it's important to understand that. And to what Artem was just saying, you have to take a long-term view to real estate investing. There are many funds who will try to acquire and exit those investments in a very short term, whether it's 3 to 5 years or 5 to 7 years. But if you're going to invest with that mindset, I would say just keep in mind that it's not really predictable when there will be a recession or when the cycle will turn. Right? Nobody could have predicted exactly when the next pandemic would have hit the world, and so no one saw this coming, but it's the reality that we're faced with. I would say the next part I believe you asked was how we're responding and planning for similar events. Is that right?
Yeah, lessons learned from COVID-19 and how you're positioning yourselves for when we get back to work.
Sure. So, one thing, I guess it really stresses the importance on maintaining sufficient working capital reserves and planning ahead. If you have debt from financing institutions, take a good look at the covenants, make sure you're keeping enough interest reserves on hand, and have a contingency plan. Where our current operations, we're able to, I guess, buffer some of the downfall a bit because we've, kept an eye to those kinds of things. But there's really no way, in my opinion, what I've learned from this is that there is no true way that you can have a perfect plan to react to this. A lot of it is crisis management and just making the best of the situation at hand. So, if you're able to reinvest and maintain those cash reserves on hand and be able to plan ahead for a down day like this, I think you'll put yourself in a better position to be able to survive and come through it on the tail end.
Thanks, Eric. Federico or anyone else want to?
Of course, Elizabeth, if you want, I can take it. It's first, I gotta tell you, that Mexico, has experienced four crises, in the last 25 years. So we're used to, what happens next. So, the first one we had, was the tequila crisis in the 95. The second one was the dot-com in the 2001, and the third one, and that's the one we lived together, is the subprime crisis that in US hit in 2008, and in Mexico it hit in 2009. And right now we are dealing with this COVID-19 crisis. In each one, we have seen a business behavior. Each one has had a V-shaped recovery, a deep economic downturn followed by a strong and steep recovery. The only thing that I would be asking, is how steep will this comeback will be, and how much time will it take us to recover what has been lost. Something that we have realized, is that each business cycle comes with new opportunities that need to be sized and taken by our companies, and that's something we just can't miss, But talking specifically about our business, is I think that this recession has shown us the important to have like our processes, operational processes, and our sales and our all the parts of our company under control. This pandemic, has whetted our appetite to innovate as an industry. And I think that we will go from being a traditional sector, to being one that will consolidate its growth on cutting edge technology. Because from an operating point of view, there will be greater industrialization and digitalization, in all the processes that make up our sector. And that's something investors are thriving to have at hand. Most of the time, when they invest in companies like ours, what our investors are looking for, are real time numbers, real time, progress on each side, real time information, And that's something that this pandemic has allowed us to develop, because we needed to, In my case, as a real estate developer, we're using a building information modeling, that allows us to centralize our design, modeling, and planning of our projects, just in one point. This generates us efficiencies when we calculate costs and we plan, the supply of input, as well as the way we optimize our structural, electrical, hydraulic, and sanitary design, that provide us accuracy to complete each project on time and within cost. That are two variables that you, as investors, look, to have control. Additionally, what we have been doing, we launched during this time, an administrative tool, that allows us to integrate, all our areas, and maximize the use of our resources, that can allow us to take advantage of our economies of scale by 100%. This system provides us with historic information, prices, precise amounts needed for each process, labor output and field earnings that would normally get lost, you know, if we didn't have like somewhere to collect all this information, you know. And I believe that that will be like one of the most important learnings, you know, we've had during this pandemic, you know, that we need to use technology, you know, in order to be able to deliver, you know, a better experience, not only for investors, but for customers, and also to allow to use to maximize, you know, the performance of our team, the use of materials and everything that we are involved in, you know, and that's the way we are handling, you know, this crisis in all the projects and developments we have here in Mexico City. So I believe that will be like our, you know, main insight, you know, during this hard time, you know, that we've lived in.
Thanks very much, Federico. Dr. Sangani, maybe in your response, could you also add a bit about how you've seen development and construction costs going up or down, or how timelines have been affected, and what are the projects that you're focused on today, and why?
Yes, the good part is across the nation, we have found that almost every state has accepted construction as an essential service. So at least in the states that we are developing, our construction has not suffered, and we are right on the time frame of projections. So that's one good news. The second potential good news is people who are in development business have found that over the past several years, the construction costs have continued to go up and up and up. And now some of these projects which were in pipeline, or where the financing or the equity were not completely secured, those projects are going to drop off. And all of us are expecting that there will be some easement on the pricing of the construction. So that's probably a good news. As far as we are concerned, we are very much in development. Just in 12 months, we have done about $500 million worth of development in the pipeline and ongoing. And we still believe that multifamily development, which is what we do, is still going very strong. Whether the recession occurs or doesn't occur, whether people are buying homes or not buying homes, the multifamily has shown tremendous resistance throughout this COVID. We only do Class A multifamily, and we have found that our collection has been in the 95 to 98% of the rent collection. Heck, where is the COVID effect, right? So what that tells you is that the impact has been in the lower paying jobs, the front facing businesses like shopping centers, retail, restaurants, hospitality industry, et cetera, but the C-class executive, the mid-level executives have not been furloughed or let go in most cases. And that's why our collection has not suffered. So we strongly believe that at the right location, a good multifamily project development is a great choice today. We are also one of the largest HUD developers in the entire country for Class A apartments. So we also get a 40% sub 3% interest, fixed interest rate, non-recourse. And then it's an unbelievable situation today because the interest rates are low. So if my only piece of advice, if there is one I can offer, and not because I'm smart, but out of experience, is that you need to be developing something that A, you believe in the market, B, you believe in the business, and C, you should not open anywhere, whatever you do at least push it out to 18 months. So if you can come in the market 18 to 24 months from now, all the people who were weak have been gone away. You are the only one standing, and you will have a great chances of having a very successful project. You will build the project for lesser the cost. We'll build the project on time for all the discussions that I just talked about. So we are very bullish on multifamily Class A development in the right location with the right construction team.
Great, thank you. I'd like to circle back to Artem because we did get a question in from the audience specifically for you. And that is, have you looked at hemp and vineyards for farmland investing?
Yep. So hemp has definitely been growing by leaps and bounds. It is a very interesting plant that has a lot of applications. We have not looked at it because, in our view, it has been tremendously oversupplied, and there's been such a rush into it that right now we feel it's a little bit of a bubble. We'll come back to it, but haven't been looking at it right now. Vineyards looked a little bit as well. The issue with vineyards is that it's a little bit of this kind of tourism, hospitality investment as well. There's a little bit of branding involved. And so we don't view it as pure farmland. So when we talk about farmland, we're talking really kind of, to a certain extent, perhaps commoditized products, whether it's almonds, whether it's, pistachios or walnuts that have deep markets, that have very established pricing, and that have well-developed ecosystems. With vineyards, the challenge you have is that you're investing as much into the operator, into the brand, as you are in the land itself. And so it makes it kind of not quite fit our farmland thesis. Now, that might change in the future, but for now, we're not really looking into those segments.
Okay, thank you. Eric, I'd like to take it back to you for a minute. I know that you have been involved in opportunity zone investing and specifically in Puerto Rico, and I was hoping maybe you could talk a little bit about that and any changes there after COVID, et cetera. What are some of the tax advantages in Puerto Rico and specifically for opportunity zone?
Sure. So I guess I'll start out for those who aren't maybe familiar with opportunity zone investing. Subsequent to the 2017 Tax Cuts and Jobs Act, the opportunity zone legislation was outlined. And if you invest capital gains in a designated opportunity zone, you can defer those capital gains until the end of 2026. You can achieve a step up in basis of now 10%, and then you have an exemption on future capital gains on the investment itself. So Puerto Rico, virtually the entire island is a designated opportunity zone. And we found a nice little niche for ourselves in the fact that we can choose locations like, historic Old San Juan or a beachfront hotel and resort, where most opportunity zones in the mainland US are inner city locations on the border of, inside cities where it's a bit of a longer term, riskier horizon investment. So in addition to that, in Puerto Rico, the island has been, in a recession for almost a decade. And so there are tourism tax credits that are offered as well. Those credits allow you to apply for a 40% tax credit on your entire project development cost, then including the cost of financing, whatever the financing portion is. And you can take those tax credits over a 3-year period or sooner if you wish. There are various ways that it works, and then on top of that, the incentives give you a 90% exemption on income tax, 100% exemption on various sales and use taxes, construction excise taxes. So I think you're getting the point that there are a lot of extra tax credits and incentives on top of strategic tax planning vehicles available in Puerto Rico. And you're seeing a lot of people come down here to invest. There are people coming down here to live. There's also a residential tax incentive for people from the US to come down here to Puerto Rico. So it's getting a lot of interest. And I think the whole coronavirus situation, I've read a few things about this new trend where people are realizing, we're all working from home and we're realizing that's possible. You see so many corporations and businesses telling their employees and announcing that they may never bring back the workers to the workforce full time. And, you know, a lot of the banks on Wall Street are even saying that they're going to reduce their rent expenses significantly. And so executives are now realizing that they don't have to commute into Manhattan if they don't want. They don't need to do that, and they can go buy a home in Florida or even in Puerto Rico, and kind of live with more space with their family and work from wherever they want. So it's definitely an interesting time, and you know, I think that us being here in Puerto Rico it could be a bit of a right time, right place situation for us.
That's great. Thank you, Eric. Kind of going back into more general, you've all touched on this a little bit, but would love to get your thoughts on, just overall thoughts on which markets do you think we will see the most change going forward? You know, post-COVID, you know, maybe we could talk a little bit about the kind of sanitation needs that are going to be necessary going forward, any other direction, permanent changes, even short-term changes that you guys see in your respective markets?
So I can probably take that. Being a physician, I may bring an added outlook towards it. And so let me address
Eric,
this.
I guess I'll take that one, Elizabeth.
Hello, can you hear me?
Can you hear me?
Yes,
Yes.
Doc, we can hear both of you.
Okay.
I think Doc was answering.
Okay, I will continue then. Is it okay, Michael?
Yeah, yes, absolutely, Doc.
Oh, okay. So being a physician, I can probably bring another aspect or outlook to the situation. And let me address the sanitation part. First of all, sanitation is always good. So I'm not going to criticize being wise, but we should not take it to the next extreme either. Too much sanitation, too many time hand washing, and too many very crude elements in some of the sanitation material can actually damage your skin. So one must be very cognizant about how they're going to use these guidelines. Second, most viruses live about 15 minutes to at the most 30 minutes on a solid surface, and they die on its own. So you're pretty much safe after, I would say, 15 to 30 minutes of any solid surface from catching anything that can infect you. And more on top of that, the only way the virus is going to come or is in your body is not by touching something to something. It is mainly coming through your nasal mucosa or the conjunctiva of the eye. So if there is only one major way of getting the virus in the system, if you wear a mask, it is pretty much a foolproof system for you to be away from the viruses. And mind you, the mask doesn't need to be N95 all the time. It can be just a regular cloth mask, and it will still eliminate majority of the times you'll be able to expose yourself. So I just want to make sure that people understand that sanitation and staying at the home is not the answer to everything. It is understanding how the disease gets there and be bold enough to accept it. Second thing people should also understand about COVID is that 80+% of the people who may be infected but will have no symptoms. So it's not something that is what we thought is a very, very deadly disease that 20, 30 million people in the United States are going to die. The latest numbers are suggesting towards 0.25 to 0.75% mortality, which kind of correlates with what flu does. So I just wanted to give a little bit background on this situation, if it helped any.
Thank you. Do you see in the hospitality industry, Doc and Eric, increased regulations in different states in terms of sanitizing and how long the rooms have to be empty, et cetera, et cetera? I mean, is this going to be a very big extra cost to bear going forward? Is it kind of a small thing? Is it a bigger thing? Short term, long term? What are your thoughts?
Eric is mainly outside of US. I'll tell you my view of US, and he can probably tell us a little bit what's going on outside the US. So because very little is known, uh, pretty much everybody has started their own rules and regulations. There are some CDC guidelines, but that continues to change. But what is here for good till the vaccine shows up is definitely the more sanitation, is definitely trying to make as much social distancing as we can, and proliferation of use of mask. And we are seeing that definitely in all our hospitality belongings. Does it increase the cost? Heck, sure, it does. Fumigation is something that I'm not sure that it's necessary all the time to do it. As I said, the virus is dying in 15 to 30 minutes regardless, but it's still done very, 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 very profusely across the nation. So, and then this is going to continue. This is not going to ease up. Whether Hilton does it differently, or Marriott does it differently, or other franchisors do differently, it's just a grade. Hilton, as we probably all know, they even invested in some of these methods of sanitation. They now have a partnership to have a special product for Hilton. So all of these things are taking a lot of attention, but I think all of this will continue till the vaccine is developed. Once the vaccine is available, I think we probably will see a lot of receding of all these measures, but till then we are stuck with increased cost and a lot more inconvenience. And Eric may have a different thought. Love to hear him too.
I agree full-heartedly with Dr. Sangani. I think in hospitality, a lot of what's going on right now, it's definitely added cost to the operators, but it's about, managing perception and making the guests feel comfortable. If you think about the very essence of hospitality, it's receiving guests and making them feel comfortable. So I think it's a necessary step that operators are taking, and Doc referenced the Hilton's partnership with Lysol. Marriott is partnering as well, and all of that is to make the guests feel comfortable. Most hotels are doing extra sanitary procedures. They have these new black light machines that come into the room and sanitize everything in 30 minutes, things like that. You'll see extra cleaning staff on site, and even if it's just for guests to see people cleaning, and it makes them subliminally feel safer and feel like everything's more sanitary. Those are the steps that hotels and hospitality venues simply need to implement right now in the near term. And I think that once the vaccine comes, I think we'll feel more comfortable again. We'll start traveling again, and we'll see things start to return to a bit of normal. But I do think there will be certain trends that will stick with us. No doubt they'll help evolve hospitality into responding to what's going on right now.
Thanks, Eric. Federico, do you have anything to add from what you're seeing in Mexico in terms of, permanent changes to the industry, any initiatives or regulations or laws being put in place?
Yeah, of course. It's here what we're seeing. Is a trend. That's changing as previously discussed by everyone. We are just having a decline, of demand for offices and retail spaces, and what we are just preparing for, is to have have more demand, in the next 5 years, for last mile logistic storage or warehouses, that will substitute these retail stores, that are closing, and allow companies that sell online like Amazon or eBay, or other tech companies, to attract the final consumer. That's one of the trends we're just having, in that industrial area. And at the residential, that's our specialty, what we're just looking, people is getting more conscious, about working or doing things at their homes. So they are asking right now for bigger spaces that allow them to have a, a more decent area to work, a more decent area to live with their families, a more decent area to, to do some things at home, because something that happened with this pandemic, is that since they realized that they can do many things from home, as one of our panelists was saying, is that they are, willing to stay more time at home or live even farther, to the places they work, in order to gain more comfort, and have more life quality, at the places they live in. So that's another trend. We're just looking, that bigger residential spaces, and also, something that will be changing, in the near future are the type of materials we are using to cover some surfaces. We will be, having the use of more, easy to clean tiles, easy to clean, walls, and different designs, that allow you to touch less, less handles, less more electronical devices that allow you to touch less, and to live more like with more safety. Those are the trends we're just watching and here in Mexico and in these two industries. Just to add on what Dr. and Eric said.
Thank you, Federico. We actually got a couple of questions in from the audience. One for you, Artem. Are you investing predominantly in U.S. farmland? And what are your thoughts on farmland here and around the world being converted to solar and wind farms?
Yeah, absolutely. I can take that. So yes, we invest solely in U.S. farmland. The reason for that is that it's some of the highest quality in the world, very stable and safe property rights. And to the extent that farming is a commodity business, US is actually the lowest cost producer, despite what a lot of people might think for a lot of products in the world, or a differentiated producer, meaning that people trust the USDA organic brand, people trust the quality of US food. Places like China, US beef, I consider premium beef something that here we buy for a couple bucks, and in a lot of places is considered a brand of quality. In terms of solar and wind farms and farmland being converted, yes, there's some farmlands being converted in solar and wind. Typically, it means quite a bit of a, you're not using the land, and just a portion of the land that gets kind of converted. Or oftentimes what also you do is that you sell a option. So you sell a solar or wind lease option to the developer that they might put it on your farm, and it doesn't cost as much, but it is another source of income. So especially there's definitely some place partners are in, sorry for a bit of background noise, increasingly gaining in the portfolios from that conversion. It is a little bit worrying. It's kind of, you're always fighting, right? You have fighting against climate change, against cost of energy. So solar and wind is obviously a good source of renewable energy, but there is a consistent decrease of farmland. In US alone, from 2012 to 2017, we lost 14 million acres of farmland in the United States alone, which is almost twice the size of Massachusetts. So there's a very real issue of farmland disappearing due to urbanization, to maybe conversion to different uses, and something that I think, as a planet and as a country, we need to think about in terms of sustainability as well as food security, and just providing for basic needs of our people. Yeah, thank you.
Thank you, Artem. Were there any other remaining questions? I think we've covered all of the audience questions.
There's another question that came in, Liz.
Okay.
It says, which real estate asset types do you believe will perform better in the near term senior housing, affordable housing, public storage, etc. And it's
Oh.
from Alexi.
Great, now I see it. It was just delayed on my screen. Thank you, Michael.
So I can take that question. So we are exposed to pretty much most of these asset types and probably not as much in the public storage. But if you start taking, let's go down the list. If you start taking office, then office sector is pretty much dead, at least for now. And Eric and other people mentioned, most people are now contemplating working from home. So it's going to be a seriously an issue of developing and renting office space. And then comes shopping centers, retail, whether it's an outdoor or malls. Malls, pretty much, the departmental stores have already cried for help, and they're pretty much out of the business one way or the other, or they're restructuring themselves. So I would say malls are pretty much out of question. Then let's go to the regular retail. Regular retail, again, with before COVID, about 14% of the total retail was done online. And the latest numbers I hear is about 28 to 30%. So retail is also on the downhill. So unless you have a very specific niche location, I would be very careful about retail. Senior housing, with COVID happening and affecting most of the older population, at least temporarily, there is a pin drop silence in that division either. So that pretty much, and then the hospitality we already addressed. There is no lender out there. And then there's nothing to develop at this time because of those issues, and because people are afraid to travel. The hospitality has a difficult time thinking that it will perform better in the near term. That leaves pretty much affordable housing and multifamily. And then we have seen that multifamily has really stood stead firm, and even B class and C class have showed a good collection. And A class has done phenomenal collection, which I just mentioned when we first started. So if anybody was going to ask me where I would take my best bet, at least for the next 6 months, for the real estate asset types that will perform better, I would think would be in the multifamily space.
I would add actually to that answer as well. I have a little bit of knowledge in the warehouse space, and especially with the acceleration of e-commerce trends post-COVID and stay-at-home orders, there's just been an explosion in e-commerce. And with Amazon and same and next day deliveries, the Amazon fulfillment centers, as well as the smaller quote unquote last mile warehouses, demand for those has really accelerated as well. So that's just another area in real estate that seems to be really picking up. We have another question here for in farmland. How can farmland opportunities be managed with so many farmers retiring and aging farmer demographics?
Yep, absolutely. Thank you for the question. So I mentioned that about 70% of farmland is expected to change hands in the next 20 years, primarily because of that demographic, which equates to about $90 billion of farmland changing hands, a lot of that on the open market. So part of the attractiveness of this asset class opening up is that before, it's just farmland would get passed on from parents to children. So you wouldn't have really an opportunity to invest as an outsider, and that is rapidly changing. And so what's happening is that the farmers that are staying, or the younger population that's getting into farming or getting back in sometimes, they are farming larger and larger acreage and using more and more technology, more ag tech technology as well to manage that. So it's actually the other answer to the question why now versus 5-10 years ago is that there's so much more now done in the area of geoimaging, satellite imaging, aero imaging, sensors for soil, remote operation of water, access to internet in remote location, thanks to, for example, Starlink being launched and other satellite type internet, and just broadband coming to rural areas. So it's becoming easier and easier to manage farmland. And I see very much a future when in 10 years you could be sitting in your home in New York and managing thousands of acres of farmland if you wanted to, because a lot of that will be done remotely.
Great. Thank you, Artem. Any other questions? Michael, we're about done on time, or do we have time for any more questions?
Yeah, you started a little bit late, so you have extra time. So if you want to take another 5 minutes, that's fine. If you want to end it here, that's also fine. It's up to you.
Okay. Let's see, is that one more question? Nope, looks like we've answered all the audience questions. I didn't have any more questions, so I guess that concludes our panel discussion. And once again, I want to thank all of our panelists and Flya and all the sponsors. And if there are any follow-up questions, I guess they direct them to you and the Flya team, Michael?
Yes, there's 2 more questions that popped in.
Oh, great. Okay. Okay, here. Are there particular farmland, is there particular farmland that will do better than others in the near future? That's for you again, Artem.
Yep. Thank you, and good to see so much interest. Yes, we are bullish on anything organic. The demand for that has been steady and growing for many years, and actually a lot of farmland just cannot catch up to the supply. That's why we're still seeing such high prices. So anything organic, anything regenerative agriculture, that type of new sustainable agriculture, I think will do quite well. In the near future, we are bullish on tree nuts, on almonds. We're bullish on pecans, and we also are bullish on apples. So we think those will do well. But overall, especially with types of farmland that grow, for example, almonds, where California produces 80% of global world almonds, is just very hard to replicate. Whereas the demand for that has been growing steadily, and people love the almonds, and the hipsters love the almond milk, or the vegetarians. So I think tree nuts overall, and anything that feeds into that kind of more plant-based diet, replacement of meat proteins with plant proteins will do well. So it's cashews as well, chickpea, those types of things I think will do incredibly well. And then one last point with farmland, because it's still such a fragmented market, a very private market. Anecdotally, the industry believes 50% of farmland deals actually change hands without ever making it to any sort of public listing. There always will be really good opportunities with individual deals, whether negotiated well, whether kind of being more creative with the deals, or finding a particular opportunity in a specific geographical segment. You can do still really well independent on what type of product it grows. So as an example, we are very bullish on Arizona, New Mexico to a certain extent, Washington, Oregon, places with excellent water will do tremendously well. So it's a long-winded answer to a question. I guess it comes to it depends and tree nuts. Thank you.
Michael, do we have time for, we have 2 more questions from the audience. Do we have time for these?
Yeah, absolutely.
Okay, great. Artem, you're on again. Can you have, these questions are, can you help farmers transition into organic farming procedures? And in response to COVID recovery, would there be more local government and developer openness to allowing residential on mixed basis to what was initially hotel use designations?
Got it. So I think that first is me, and then the second would be the panelists. Yes, so absolutely. And in fact, the main issue with transition to organic is that there's too much of an outlay of cash by the farmer, and there's too much sometimes of an execution risk, where if you don't transition with the protocols properly, you can lose You can lose a year. Sometimes for some products, the difference in conventional organic pricing just doesn't make sense. But overall, I would say the biggest issue is that cash outflow, and that's why that's exactly what we're working on, is working with farmers to provide them with that certainty and stability. Either it's a sale leaseback, during which we invest into the organic transition and the farmer buys it back from us once it's already organic, or just coming in honestly as a capital provider to the farmers, where unfortunately that market isn't yet well developed. So that whole transition of conventional to organic isn't as well established market as just a first lien senior type mortgage for buying the land. Just the overall financial market and institutions and products in farmland, we have a saying that's 20 years behind real estate. So we're trying to accelerate their transition and kind of skate to what the puck is going to be. So hopefully we'll be, in 5 years, and farmland real estate will be in 5 years. But yes, it's definitely a huge opportunity and big lack of capital even today.
Thank you very much. I'll repeat this second question for the other panelists. In response to COVID recovery, would there be more local government and developer openness to allowing residential on mixed basis to what was initially hotel use designations?
I'll jump in first, Liz. So I think the answer to Rob's question would be yes. It's usually more difficult to go from a hotel use designation to residential than the other way around, because you'll have to be commercially zoned. So I think from the governmental standpoint, they should be open to that. From a developer standpoint, the name of the game is being able to adapt and pivot. So if credit lines are tight and developers can't get, the lending to be able to move forward with their hotel projects, I definitely think it makes sense to consider multifamily, residential, or some alternate use for the building, highest and best use at the moment in time.
Thank you. Anyone else want to comment on that? Doc, you have any thoughts on that, or Federico? Okay, we have one more question here then. I think it's again from Arden. Given the huge success of Beyond Meat, can you speak to this type of farm distribution?
Yeah, absolutely. So companies like Beyond Meat, Impossible Burger, just for broad audience, these are companies that create what essentially tastes, feels, smells, texturizes like meat, but isn't meat. So it's vegetable proteins. And those are exploding both because of more and more people kind of becoming vegetarians, people worried about their health, people worried about the planet. So there's a lot of drivers there, and Beyond Meat had an insane IPO, and just still the stock is crushing it. So definitely a lot of demand from the consumer, and farming actually in certain areas cannot catch up. So in the case of Beyond Meat, I believe most of the meat substitutes are made from mixtures of pea protein, isolates, rice protein, mung bean protein, as well as some canola, coconut oil, and other ingredients, potato starch, apple, sunflower. So what we're looking for in Farm Together is to exposure to that type of farmland. And typically those companies, they also skew organic, or at least sustainable sourcing. They want to make sure that the operations themselves are well run, that the farmers are taking care of the workers, of the health, which is what we always look for as well. And so that would be the types of farms we're looking for. So I kind of maybe will contradict myself a little bit, where I say broadly farming is a commodity, and that's just the truth, and it's fine. But within that, you can absolutely find more differentiated types of farms where other things matter to the buyers as well, and you can differentiate based on that. And so that's something that we're looking for. I think overall, again, like pea proteins, chickpeas, rice, beans, they will continue their growth. Another one, interesting one, is beets. That kind of is used to create a type of blood feel texture. So beets might have a good kind of rally behind them as well if this trend continues, which we believe it will.
Do you do anything in organic seed farms, Artem?
Not sure what you mean, Elizabeth. We use so when it's organic farms, we would use organic seeds, but typically with farming, when you're doing development, you buy already existing trees from nurseries, so they would kind of grow them from seed, to 1, 2, 3 years old, and then you plant it. So we don't do as much in actually growing trees or other types of products from the seed. If it's row crop, so you're planting every year, we're using a seed, then you would be using kind of more organic suppliers. But typically, that's a little bit further down, or I guess further up the value chain, the stream, whereas we focus mostly on the land component, but in an organic deal.
Thank you. We have another question for the hotel panelists. Would it be difficult for hotels to convert to an extended stay, assuming it wasn't already?
I'll give my opinion, and then I don't know if Doc wants to add to that. It depends. I think it's definitely doable if the management team and the owner are willing to adapt and implement a different style of service. And of course, if you have the facilities to do so. So you'll have to have space. Guests will probably you'll need to have the right equipment, whether it be a mini fridge or a microwave, or be able to provide some of those services for people to be comfortable with a longer stay.
Doc, do you have any thoughts? Are you still on?
Let me see if Doc is still on the line. Hang on one second. I think Doc had to drop off at 4 o'clock.
Okay. We have one more here, Michael, if we have the time for Artem.
Okay, yeah, let's after this one wrap it up.
Okay.
All right.
So Artem, the question is thoughts on hydroponics and competition?
Yep, absolutely. I saw that question. So hydroponics mainly used for growing cannabis. We don't touch that. Some other kind of those types of products, but in terms of competition, I think to expand the question a little bit, we're talking about indoor farming and sort of non-farmland competition. Indoor farming is interesting. It mainly works for very high value products that don't require a lot of land. So this is typically leafy greens, can also be some herbs and some ultra local stuff going to expensive restaurants. But overall, on an asset class level, it is just, impossible to beat free energy from the sun, free water from the rain, or from kind of groundwater, which is much cheaper, as well as what's really important is the inherent biodiversity and resilience, especially if it's talking about organic regenerative farms, from variety of pests and other bugs and just harmful microbes. What's important to remember in indoor farming, you're dealing with a closed ecosystem, and those things are notoriously hard to manage. You deal with a lot of issues there. So I think on the fringes, indoor farming might have some impact, and we might even do an indoor farm one day on our platform. But overall, I don't think it's going to put a dent in the in the value in the prices of farmland long term on a macro scale.
Okay, great. Well, I guess that concludes our discussion. I want to thank everyone for attending the panel, and thanks again, Michael and Flya and all the sponsors, and thanks for inviting me to moderate this panel. Everyone stay safe and healthy.
Thank you, everyone.
Thank you. Thank you,
Adios,
everybody.
Elizabeth.
Thank you for joining us today for the Flya Real Estate Direct Lending and Private Debt Forum, Part 4. We'd also like to thank our sponsors, Nationwide, Prequin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Off the Chain Capital, and Clarion Asset Management. Last but not least, we'd like to thank our panelists for providing their expertise and commentary today. Thank you to all. Have a good day.